So now moving forward, let's talk earnings. Now Raymond reported numbers which actually came in pretty weak. The stock is down over 4% this morning. The company saw losses widening, coming in at 16.61 crores versus about 14.4 crores same time last year. Joining us to walk us through the numbers is Sanjay Bahl, Group CFO, Raymond. Now, sir, my first question to you is, the sales growth had slowed to 4% versus the 8% the last quarter, but you have reported double-digit volume growth in a number of categories. And if I was looking at the headlines, in fact, the volume growth has been strong within the categories. So please help us to understand the results, the price volume trend, and if there was any softness in the demand.
Yes, so let me first give you the headline on the key metrics, and then I will decode the results for you. So first, yes, it's an overall 4% volume growth. Gross margins have grown by 3.4%. Our EBITDA has grown by 5.1%, and the PBT has shown a growth of 17%. At the PAT level, we see a decline of, in value terms, 2 crores, which translates to a 15% drop. That's on account of really the results of our associate company in the FMCG business. So that's the headline numbers. Now, I must qualify these headline numbers and point out that last year's numbers account for a 12 crore one-time benefit, 8 crores on account of a power subsidy that was received in the previous year, and 4 crore on account of a one-time sale of an immovable asset in the apparel side of a business. After having adjusted for this 12 crore benefit of the previous year, actually our EBITDA reflects a 32% increase on the back of a 4% growth in turnover. So this is a positive underlying result from the overall business portfolio. Specifically, what we have seen in this quarter, the market conditions, we have been quite challenging. Traditionally, quarter one is a weak quarter from a seasonal perspective for the suitings business. However, there has been sluggish consumer demand in the quarter, as there has been a complete absence of festival and marriage dates in this quarter as compared to the previous year. Also, the retail demand has been quite slow, resulting in slowdown in footfalls in malls and into stores, which has resulted in the early onset of the end of season sale on the branded retail side. So these have been the challenging market conditions. So when we view the results against these market conditions, I think an overall positive growth story across both revenue and all the profit metrics, we see that as a very positive sign.
So if I'm looking at the employee expenses, they have jumped by more than 10%. So should we be concerned about the wage pressure here, or is it related to new investments or bonus in this quarter?
No, I think as I explained to you, the quarter one traditionally is a weak quarter during the whole year. So the wage cost as a percentage of sales has to be seen in that perspective. Yes, the wage increase is there because of the bonus which was announced last year. So that has to be factored into this year, which was not there in the previous year. So that impact has come in with the revision in the Payment of Bonus Act. However, the increase in cost as a percentage of sale is really a reflection of the total turnover for the quarter, which, if you look at the historically, the remaining 3 quarters, the turnover increase, which is traditionally seen, will clearly offset this increase in percentage that you see. Overall, if I look at the operating costs, the operating costs have been lower in the quarter. So even against a backdrop of a slowdown in volumes in our suitings business, we have seen the other segments outperforming, which has helped to give us overall volume growth and a margin growth as well. If I come to specific segments, our shirting business has increased in volume by 26% and margin by 33%. Our garmenting business has grown by 19% during the quarter. Our branded apparel business has grown by 17%. and our auto business has grown by 14%. So overall, across the different business segments, we have seen positive growth, and this momentum we expect to continue during the remainder of the year. And the suiting business, we see a very encouraging sign in terms of the seasonal bookings that we have from trade. That has been very encouraging response from trade, and we see the secondaries now coming in the second half of the year with the onset of a lot of marriages, dates, festivals, and the festival season is also in early this year. So positive signs on the suiting side, and the momentum on the other businesses is likely to continue.
Well, cotton prices saw a very sharp rally over the last 4 to 5 months. Was there an adverse impact from high cotton prices in this quarter? And also, could we expect a negative impact in the Q2 also?
Yes, cotton is impacting the business because the surge has been unprecedented and clearly could not be forecast, as all the earlier forecasts were not reflecting the kind of increase that we have witnessed. So it has grown by 40%, and it's something that we will now have to look at in terms of, how do we pass this on, and by way of in price increase as well, and how to absorb this. So clearly the inventories, we do not do a strategic stocking of cotton. We do not get into any speculative stocking of commodities. So clearly, yes, on the operating side, this will have to be absorbed and also reflected in pricing.
So if I'm looking at the balance sheet, the interest expenses, they seem to be very high compared to the operating profit, but the net debt to equity still seems to be fine. So what is it related to, and how are you planning to reduce it?
See, interest expenses are, if you see the capitalizations which have happened, we've continued with the CapEx program over the last 2 years of capacity expansions, which we've had in the denim business and the shirting business. We continue to invest in our expansion of our retail outlets in the branded apparel business. So these CapEx expansion plans are likely to are going to continue this year as well. We will continue to invest in expansion of our branded apparel business. So interest cost quarter on quarter has reduced by nearly 4%, but it's really unlocking our working capital that we are looking at as a strategic initiative, and that may help us to reduce the interest cost.
Fair enough. We understand you're in the middle of an investment phase, like retail network expansion at present. Like, what's the expansion, the CapEx plan for this year?
CapEx will be in the range of around 250 to 300 crores, which will include maintenance CapEx, also investment in our expansion plans for the branded apparel stores, and also it takes into account the investment in our garmenting unit in Ethiopia that we are investing in.
Any plans around a non-core asset monetization like the Thane land or others? And also, if you could add some color on how the earnings outlook is going to pan out for the remaining part of the year?
See, first on the real estate side, we've said before that there is a management team that is in place. We are looking at monetizing the real estate assets that we have. The development plans are being put in place. It's a question of time in terms of getting various approvals, permissions, etc., which are required in the real estate space. So that process is already on. On the outlook for the remainder of the year, quarter one, as I explained earlier, is traditionally a weak quarter. However, we have come out of this quarter on the positive side across all metrics. So that's a healthy sign. Our business segments are performing well. That momentum is likely to continue. Our earnings, gross margins have been held in the suitings business in a difficult quarter, and in the other businesses have shown an increase. So with both these, volume growth and the margin growth that we see, we expect that the remainder part of the year to be a much better performance as compared to the previous year.
Thanks a lot, Mr. Bahl, for all the insights into the quarterly results. Good luck for the remaining part of the year. Always a pleasure talking to you. So that was Raymond results, and the stock is down around 4.5%, primarily because the numbers have not been that good on the bottom line side. The margins have been stable. So time for a short break. On the other side, we are going to hear from the market guru of the day, Anil Ahuja, CEO, IP Plus Advisors, on his top market strategies. Stay tuned.